Well, folks, the holiday season is upon us, and that means it's time to talk taxes. Time to talk taxes with 11 end-of-year tax tips to help you save money or take advantage of some tax strategies before year end. So let's hop right on into it. So, first tip, hit the 401k max for pre-tax. So if you're under 50, that's $19,500 this year. Next year it goes up, but anyways, for this year's $19,500. If you're 50 at any point this year, you can put in an additional catch-up of $6,500. So log on, look at your 401k through your work provider, and if you're not going to hit it, adjust with a few weeks left. Maybe put in more or all of your last paycheck to hit that level, defer more taxes, lower your taxable income. Tip 1. Tip 2, charge for charity. You can charge this year. Maybe you get your bonus early next year and you're philanthropic. Well, you can write off for charity. It's that when you charge it, not when you pay it. So if you charge December 16th and your billing cycle is the 15th for credit cards, well, that charge, you won't owe that charge to mid-February by the time you have to pay it. So pretty cool strategy to take advantage of sort of arbitrage of timing of bonuses and charity to still get credit this year. Next, tax tip 3, tax loss harvest. It's a great way. Maybe you have a lot of capital gains this year realized and you have some losing or loser positions. What you can do is you can sell at a loss and force the loss to offset gains and lower your tax exposure this year. So we try to do it in some of our portfolios this year. Admittedly, is going to be a little tougher because there is not a lot of losses with a good year in the markets. Next, IRA to Roth IRA conversions. So still some time left. You may have a better understanding of what your tax picture looks like and your taxable income is. Well, you can try to convert some IRA to a Roth and stay under a certain tax bracket or within your same tax bracket and take advantage of potentially lowering or converting more dollars to a Roth and letting them grow tax-free, utilizing what you know is still fairly favorable tax rates. Next, back to charity. You can give low basis stock to a charity. So you own a share of Apple, you bought for $1, it's worth $100,000. You can, if you sell it, at any point when you sell, you're going to realize real gains. So instead, what you can do is you can gift that share to charity of your choosing, get a deduction for $100,000, and never have to worry about paying tax on that gain. It's a great way to give to a charity, which of course is always a passion of mine, and to benefit from a tax standpoint and get out of nasty capital gain situations. Do a qualified charitable distribution. So back to charity, if you're at RMD age, required minimum distribution, this year 72 or older, you can take up to $100,000 of your required amount and not even take possession of it, give it directly to a charity, no taxes owed whatsoever. And so if you're going to give to a charity anyways, and you are RMD age, do it from your IRA funds that are coming out, skip a step, pay no taxes, win for everyone. Next, the after-tax contribution to your company 401k. So not all companies have this. It's the strategy I've talked about before, the mega backdoor Roth. What you can do is, if you're already maxing out pre-tax and hit your $19,500, let's say, you could put a boatload of money after tax. Not a huge benefit on the surface, but then you can have those dollars sent home, convert to a Roth on dollars that you couldn't have saved pre-tax anyways, and hence make a sizable Roth contribution where previously you were not able to. Great strategy, big fan. Hire your children. So if you are a solo business owner or a business owner and you could put your children on the payroll or have them through a separate entity, and you can deduct $12,550 or pay them $12,550. They take the standard deduction and hence no taxes. You can use that to pay for childcare or whatever have you, and it's a great way to pay no taxes on some of your funds and have your kids have some sort of culpability. And even better yet, you could take some of those funds, put into a Roth IRA, and double whammy, if you will. Hire your spouse. Again, these are for business owners. You can put your spouse on the payroll, give him or her some sort of job or duty. They can max out a 401k if you pay them enough. If they are not otherwise working, you can help their Social Security formula by contributing and them earning wages. And it's a great way to, again, save more money pre-tax. Last two, max out your HSA. So if you're in a high deductible plan and have a health savings account, you can put $7,000 plus, I believe, this year away pre-tax. Beautiful thing about that HSA, one, you don't have to use it by year end. Two, it comes out tax-free. So it's a pre-tax and tax-free when it comes out. Great funds, and let's be honest, the way medical care is going, you're going to use that funds someday regardless. And, oh, by the way, a lot of these plans have investments within their HSAs, especially once you hit a certain level. And finally, those with children, 529s. A lot of states allow you to contribute a certain amount into a 529, check your state rules, and get a state tax deduction. I know Pennsylvania, it's $15,000 per kid. You can contribute to any state's 529, and that $15,000 will not count, or you can get a deduction on your state income. Not a ton of dollars, but it's dollars in your pocket versus the government's. Usually a win for most people. All right, there it is, 11 wonderful tax tips for year end to take advantage of. Of course, reach out to us if you have any questions. As always, I'm Andrew Rosen, president of Diversified. Stay wealthy, stay healthy, and stay happy.